Welcome to The Buy-In. My name is Trent Cripps, Director of Property Strategy at Sevenfold Property Group, and I'm also a long-time avid property investor myself. Please note, all the opinions and information in this podcast are of general nature only and should not be relied upon as advice. You should always seek professional guidance at all times before making any investment decisions. Please see the link at the bottom of each episode. Okay, we're back for another version of government announcements. So I've got Gareth joining us again and Bodie, and welcome to the panel, Nick Selbie, who is Director of Commercial and all things commercial, so very much in the leasing, sales and investment space. So welcome.
Thank you, Trent.
So Gareth, I'm going to throw to you again first.
All right.
What's changed in the last week or two? It's just a continuation of announcements. Let's jump into it.
Yeah, more than a continuation of announcements, it's clarity. So we've been waiting for 6 weeks for confirmation as to what we're actually dealing with. So lots of horse trading, lots of changes to finally get to, well, what are we actually dealing with? We'll go through what we now know. There's lots to unpack in terms of what we thought would be in, how that changed and evolved as there was negotiations as to getting other parties to push this through both the lower and upper house. But there's still stuff we don't know. So there is a couple of little nuggets in there, which is the second round of legislation, which we're still waiting on to come through, which was really the things that they couldn't thrash out while they were trying to push through the major changes. So there are a couple of property things which are going to be really important, particularly what is the definition of new residential property? We still don't know.
And in this latest announcement, we've also roped in self-managed super funds. They've been affected by this. So can you give us some clarity on that? Yeah, last minute decision?
Last minute sort of
or not
curveball, which none of us really expected. Massive change, huge change. Personally, not really sure how this helps with housing supply, and I'm sure you've got views on that. But so last minute to get the Green support through the Senate. The government had to concede to banning limited recourse borrowing arrangements, which is just a fancy way of saying using borrowed funds to settle the purchase of a residential property. So keen on Nick's thoughts on commercial, because that was carved out, so you can still borrow money to settle on a commercial property, but from the 10th of August, we won't be able to use borrowed money to settle on purchasing property inside a self-managed super fund.
Yeah, well, look, just for context, I'm actually going to put on my glasses, and I want to read a few stats. So there's approximately 1.2 million Australians or members across 663,000 self-managed super funds in Australia. The Australian residential property is valued as a total residential property category is valued at over $12.6 trillion. Limited recourse borrowing arrangements, which is what the government is now axing, are said to be valued at about $56 billion. So it's actually about 1% of total residential borrowing. So my question to you is it really that big an impact in housing pricing and supply?
It's an interesting stat. What would be more interesting would be what's the total value of SMSF owned property, not borrowing. And then there's a really important point here, because as we've seen, a lot of clients have bought property, done it extremely well. It's been a great investment for providing for their retirement. The structure of a limited recourse borrowing arrangement means that you cannot refinance after you've settled to increase the loan. So we've seen a lot of our clients, as you know, buy a property. They might have borrowed 80% at purchase at settlement date. Over time, it's gone up in value. And we've had clients where they've had in excess of $1 million worth of equity built into that property, might be worth $1.5 million, and they've got $500,000 worth of borrowing. Your stat is talking about the $500,000 worth of borrowing, not the $1.5 million worth of property that's being supplied. Right. So I think the government have been quite clever in using that statistic around how much the lending contributes to the lending space. But what's the true value of the total supply of housing provided by SMSFs in comparison to the entire market?
Yeah, and the other stat here, and what my major concern, and we'll go down a little path here, is that the average self-managed super fund, the members are over 50, and with property inside a self-managed super fund, it's just the mum and dad that are battling away to secure their financial future for retirement. So if that's taken away from people in the future, how are people going to fund their retirement? Because there's a stat you and I both know. When they first introduced the pension into Australia, there were 64 taxpayers for every retiree.
Yeah.
By the time future generations retire, there'll be one taxpayer for every retiree. So albeit this government might not be in, future governments are going to get stuck holding, a hot potato, which is trying to fund people's retirement.
Or worse, which is the sad consequence is that the standard of living in Australia will drop.
Yeah.
You live within your means of what you actually have to retire on, and that's not going to be the lucky country anymore. You are going to have to probably curb what your expectations are in retirement because you won't get an age pension. What's available now is pretty limited. It doesn't provide much of a lifestyle. So moving forward, if you can't fund your retirement to your expectations, then you have to limit your expenses.
Which is creating a further divide between the wealthy and the poor. The middle class are going to be the ones that suffer.
Well, let's be honest here. We've had a number of approaches from clients where they're saying, why stay here? I'm in a role that has got the ability for me to do that overseas. Do I really want to stay in Australia anymore? Their prospects, their long-term wealth strategy for a number of them is better served outside of Australia under this new regime.
Yeah.
The Greens framed this, though, which is interesting, as closing a loophole for wealthy property investors. So I'm going to get on my high horse with some statistics now. The ATO data does tell a different story. So the loans that were most commonly amongst self-managed super funds with balances of $500,000 to $1 million. So it's not the ultra wealthy, which is what they're saying it is. Then 41% of self-managed super funds owned residential properties in 23 and 24, including those who had bought it without a loan. So what they've said they're doing versus what they're actually doing is counterproductive.
Absolutely. It comes back to my point. It's the average mum and dad that have been working hard for 30 years, contributing to super and their employers' super contributions going in, to get to a balance where they can do something, a little bit more active to just ensure that they've got financial security at retirement. It's not the super wealthy. So it's a crazy move. But anyway, it's happened and it's happening, So
I think, I thought in the negotiations to try and get support from the Greens that there might have been potentially maybe some discussion around similar restrictions around only using it for new property. So still encouraging a new supply in the same way that they've grandfathered negative gearing. They could have done the same thing. Interesting to know what the statistics are, which I don't know, as to how many residential properties were acquired by self-managed super funds last year. You can't help but wonder, without that sort of demand or from SMSFs and therefore supply into the rental market, what will that do to rental prices to actually increase them even further than they were already going to do based on curbing investment outside of super?
Yeah, I mean, it's certainly going to depend on location and what the calibre of the property is. But for mine, I would say by the end of 2027, the average house, call it a 3 or 4 bedroom house, is most likely probably going to be $100 a week higher than what it is now. So it's going to have an impact, which it's a long way above the $2 a week that the government was saying at budget night. So, yeah, it's interesting. So what does that mean for the future of SMSFs? Is it still a relevant and viable option? Because I want to bring Nick into the conversation in a second. But from a diversification perspective, is it still a viable option to have a self-managed super fund?
Yeah, it is. There's a lot of other reasons that you have self-managed super funds. It's not simply only because of residential property, despite what you might think. But there are lots of other reasons. Commercial we'll talk about in a moment, which is incredibly viable too. I think, there will be solutions come into this space. I think there will be fractional ownership opportunities for SMSFs, which will still allow exposure to geared residential property, but just not through limited recourse borrowing arrangements. But there are still lots of other reasons to do SMSFs, and that is around control, around the investment selection, but also timing of what you do inside the fund. It's not the end of SMSFs, but certainly a lot of demand has been previously from residential property investors.
I think to jump in there as well, it's still a tax-effective environment and one of the most beneficial tax-effective environments in Australia. So it's still taxed 15% in accumulation and 0% in pension phase. So for everybody that does have a property inside of self-managed super fund, they're definitely going the right way.
Yeah, and if you do own a property inside a self-managed super fund, hold on to it till retirement.
Yeah.
Don't let go of that, because you are probably now considered one of the minority in Australia.
And look, reality is that, we've seen plenty of this in the accounting space where, between successive governments, they change things. So we have certain rules that apply from this period to this period, another rule that applies from this period to another. I think this is going to be a really major part of political debate going into the next federal election. It's not inconceivable that this all gets unwound again in a couple of years. So, in which case we're going to have this, quite an interesting time ahead of us.
So as you identified, one of the areas that haven't been touched is you can still borrow inside a self-managed super fund, limited recourse borrowing arrangement for commercial property. So Nick, I just want to bring you into the conversation here. What does that look like for the average couple that have a self-managed super fund? What are some of the things that in the commercial space that they could invest in?
I think one of the main vehicles that people use that structure for is for their own business, to purchase a premises that they can lease back to their own business, which works very well. They provide their business with a secure premises for however long a period they wish that business to be there, and then that investment, that rent, is going back into their investment and their super for the long haul. So I think also as an investment vehicle, the fundamentals still need to be ticked for which properties, because you really you need a tenant, you need a good lease, you need all of those things in order to service that fund. So, but yeah, it's certainly flavour of the month at the moment, which comes with some cautionary, I guess, ideas around commercial property and why everyone's talking about it. So it's an interesting time, but commercial, as you say, hasn't really been touched, and there's a lot more interest right now. Absolutely.
And is that reflecting on figures, or is that just really an inquiry rate at this stage?
Inquiry rate, definitely, but I think it will have an effect of compressing some yields and returns in certain property types and assets. I think probably at the lower end of the value in those type of assets. So, around that 1 mil, sub 1 mil bracket, where people have, realised some equity in those residential properties and looking for a first entry point into commercial. So, there is a lot more interest around those sub mil properties, which come with their own intricacies. So, there's a lot of layers to commercial property. So, it does take a lot more DD in terms of what works for you. So, yeah, definitely there's a lot more interest there. Yeah.
So don't be jumping into a storage shed in Timbuktu.
Oh, well, we could make a whole thing on this about, a lot of investors chase just pure yield in commercial, and that's quite a dangerous concept. And we've seen a lot of interest at the moment of people looking at the commercial market. A lot of buyers agents from residential, coming to look at the commercial side of things, because some of their pipeline may have dried up in residential. And it's pretty easy to look at paper numbers on a commercial property, chasing a 7% yield or something like that. And I guess just pare back a little bit. your yields in commercial, why it's attractive and why people look at commercial is to generate cash flow generally. There is capital growth, of course, but generally speaking, we've seen investors build some equity in their portfolio through residential, and then at a time either they've maxed out their borrowing capacity in residential side of things, and they're at a stage in their journey where they're looking to experience some cash flow or generate some income out of those properties. So that's when they come to commercial. So instantly they come over and they say, oh, that one looks nice. It's a 7% yield, net yield, which, just simply means that it's the total return. The tenant in commercial generally pays 100% of the outgoings. So your return, your 6%, 7%, whatever it might be, is pure return. So that's the general main advantage of commercial. But if you're chasing a high yield, simply, it generally comes with some risk because either there's not as much demand for that, or there's higher vacancy in that asset or that area, or the lease isn't very strong, the tenant isn't very strong. So you could compare a 7%, and generally speaking, it'll be a regional type asset. It might be I won't say any areas because I don't want to talk. Let's call it a regional asset versus something that's, you look at it's a 5% net return in a solid capital city where there's low vacancy. Very quickly that lower yield property can outperform the higher yielded property. Just based on, you could have some vacancy period, your tenant could fall over, and then you have to wear some of that cost of the time, the letting up period, the costs associated with that. If you looked over a 10-year period, you more likely than not, your lower yielding asset will outperform that for purely on fundamentals. So, it's there's a lot to analyse and look at, and the layers, and I just think there's a lot more people looking at commercial now that may make some decisions based on not all of the boxes being ticked or the knowledge or the experience of what they need to look at.
How does residential, just for people listening, buying a residential property versus a commercial property, what are the things you should look at, obviously, apart from yield?
Yeah. Well, your growth is predominantly driven, if it's an investment, predominantly driven by the lease and the income growth. So the key points would be the strength of the tenant, the strength of the lease. So that might mean the increases per year because you're compounding, the annual increases in a lease might be, let's call it 4%. So how strong is that tenant? How long is that lease? And you can compound that increase each year. Plus, if it's ticking the other fundamentals of location and amenity and transport and growth and all those sort of things, you get your capital growth of the property as well on top of the lease growth. So there's those things. Not always, though. You're looking for a long lease, and there's some upside potential when you look at, there's opportunity in shorter leases. It might be under rented. It may be underutilized, the site, so you can take on a shorter lease with that longer term in mind, where you can add some value, and you might revert the rent. It might go up 20% based on current market, and it's been under rented. So all of a sudden you can have some really quick growth just by understanding the market and vacancy and demand and supply and all those sort of things. So there's a few things to have a look at, but there's various ways you can make a commercial property really work.
I want to bring it back to advice. Obviously, with what Nick's touched on there, commercial may or may not suit everyone's circumstances. So the devil is in the detail of the advice and what you're trying to achieve, what your goals are, which very much falls back into financial planning advice with self-managed super funds. I have noticed there's a lot of noise out there at the moment in relation to all the government announcements and changes, and how people are interpreting it. And there's a lot of people out there that are trying to get people to rush into things. That's certainly not our approach. I want to throw to you, Gareth, and talk about our process and why the advice should be considered and not to try and beat a deadline of, say, August 10.
Yep. So our process is always goals related. So it's a goals driven strategy. And the goal that we're predominantly talking about with super is in relation to retirement. So how are you going to fund your pension or your retirement benefits? So whatever mix of investments, assets that looks like is generally related to where you are in that journey. So a great example, historically, residential property in Australia has been a great accumulator of wealth, whereas commercial is a better cash flow asset. And so when you're working and you're not relying obviously yet on that capital base to provide a pension, we're wanting it to build up as much as possible. So we would look at those sorts of assets that create that growth. Potentially in pension phase, when you're looking for a reliable income, that's where you might switch to like a commercial asset. So our process is always what is the goal, what's the right vehicle, and then go and find the appropriate investments or asset that actually will deliver to it. So that process shouldn't change even if there's a deadline. And you run the risk of rushing for the sake of getting before 10th of August, signing a contract so you can buy something with borrowed funds, but maybe you're buying the wrong thing.
Yeah, exactly.
Maybe you're competing with 5 other people for that particular asset. You overpay for it, and then you take the next 5 years for the market to correct, and you've actually made nothing out of it. So there's a real risk of rushing. It is about what's the logic behind it? Is it the right thing? Is it going to deliver? If it's not going to deliver, you don't have comfort around it, don't do it. There will be other options. So the advice component is a critical part to make sure it actually is going to deliver for, if it is retirement or not. So
I think, Gareth, to that point, it's similar to the questions we ask for commercial as yourselves do in your space. What are we trying to achieve? In what time frame? And what is the capacity?
Yeah.
Right. So, and we had a client the other day who presented and said, we need some cash flow in 2 years' time because we have some, I think it was private schooling expenses coming up. So, and then understanding the other people, we've got the timing, we've got the reasoning, and then we need to understand the capacity and then try and find the asset that fits that goal or strategy.
Exactly.
So, it's important.
Gareth, any thoughts as to why commercial would have been untouched?
I think it was probably untouched because business owners in Australia typically invest in their own businesses and they accumulate wealth by growing their businesses with an expectation that they'll sell their business and the capital that comes from that is what will provide for their retirement. So this allows them to acquire commercial assets for their business, whether it be a warehouse or a shop or office, allow for tax deductions within their business for their business to pay rent, a slightly lower tax rate inside super. And so it allows for this gradual increase of wealth inside super by owning an asset that the business can use. So there's a few other things to consider, Nick, that, as a business owner, they need to think about as well.
Yeah, a couple of points. And when they're leasing to their business, it must be at a commercial market rent. It's got to be deemed as an arm's length transaction. The lending can only be used for the purchase of the property, correct?
Yeah.
And not for renovations or anything else in that property. But as long as it ticks market rent and it can be justified, then it's a real opportunity.
And I think the lending piece is an important part because it is quite different to the residential borrowing capacity. And really interesting, I guess, in that residential side first, where you and I have been talking for a little while, where really good quality residential assets were becoming problematic to acquire inside an SMSF. So to unpack it for everyone, the way servicing worked because it's now coming to an end, was that the funders would look at what are the contributions the members have been making. Concessional contributions are currently capped at $30,000 a year. So standard sort of 2-member fund, you'd have a maximum $60,000 of contributions. That includes, employer contributions, etc. And then whatever rent that you're expecting to get from the property you're acquiring. That's the total amount that you've got to service the debt. When we looked at calculators across the lenders in the SMSF space, we're really looking at a max loan of up around $900,000 to $1 million. So if you're looking at capital cities like Brisbane, you're probably looking at about a $1.65 million purchase. You're looking about 750 plus costs of money from your super fund to get into it. And that was starting to get probably where does it still make sense? So even without banning it, it probably had some changes coming anyway.
Yeah, that's right.
Contrast that with commercial, where again, it's about what is the income coming into the super fund that can be used to actually pay the loan repayments. And so lenders will look at your business financials and say, well, if you're already renting an office or a shop or warehouse, whatever it is, and you've done that for a period of time, you can evidence that your business can afford to pay that rent, and therefore it can be used to service the debt. So the borrowing capacity in a lot of cases is a lot higher for commercial because of that servicing component, whereas residential, typically the rental yield's lower, and so the capacity is lower as well.
Seems strange that more people haven't gotten into commercial then. I guess it's maybe the level of complexities and very much you should sort a professional in relation to buying commercial.
I think comfort levels too.
Yeah.
People more familiar with bricks and mortar residential. So whereas there's a bit to learn about commercial, as Nick's saying, that your probably average SMSF investor is probably more familiar and more comfortable with residential today.
Yeah, and I think it's a common question we get asked about what is the cost to aside from the super investment vehicles, for the business owner. If you're a straight investor, the entry costs can be, more substantial or to the average investor who's coming from the residential. I mean, your lending would typically be 60-70% LVR. So if you're looking at $1 million property, that deposit required to start with is $300,000 to $400,000, which a lot of the entrance into commercial from residential, it's from equity they've created. If commercial, contrasting to residential, you're not looking for leverage as much. You're not trying to put as little as possible to leverage into multiple other properties. You're putting in as much as you can so you can leverage. Cash flow is key. Mm-hmm. So you're trying to get the cash and not buy multiple, more properties to create equity. You're just there for cash flow generally.
That being said, though, it'll be interesting to watch the capital growth of commercial properties now that basically residential is out of the question. So it'll be interesting to see how that capital growth goes. Will it skyrocket, or do you think it'll remain steady because of the complexities?
And I think it's probably a misconception that commercial property doesn't have capital growth, because it simply, has to if based on the supply and demand and the costs of the properties. So based on the yields and things. So yes, yields have already compressed and continue to do so in much of the in-demand areas. But yeah, there will be capital growth in those properties, yes.
For the debate, if I can play devil's advocate, obviously being in my little world of residential, I'm focused there. With commercial, and I'm going to throw to you in a minute about small business and how that's been impacted. But before we do, what I can't help but think is if business has been affected, and we're taking basically as a result of this budget, we're sucking away a lot of the desire and the entrepreneurship of starting new business and building business because everything's been taxed so heavily. Is there a knock-on effect with commercial property as a result of that? Because I think people that were thinking of starting a new business might be thinking twice now.
Yeah, I think there's a few things that are happening anyway. So we've just recently seen payday super come in. So small businesses dealing with that cash flow constraint. We've got question marks over where is the RBA at with inflation and interest rates. And so there's a lot of hesitation just through, sitting on hands because people aren't sure. And there are some challenges. We saw, into a new financial year, we've got new award rates come through. We've seen payday super come in. There's a lot of things around small business probably would stop people right now being entrepreneurial and saying, hey, let's give it a crack. Let's wait and see how the dust settles beforehand is probably where a lot of people are at.
Yeah, because my concern is, does that flow on to the need for commercial property?
And there's always peaks, troughs in each industry, I guess, or asset class. And, would I buy a CBD strata office space? Probably not right now. But would I look at a suburban office building that had, 3/4 of office space and have a retail presence or something, COVID really hurt office space. It's coming back depending on what industry, but there's always going to be some things that create some ups and downs, and asset classes will shift with that. The warehousing, the technology, the distribution, data centers, all of those sort of things are exploding. Medical, there's going to continue to be demand for that space. So as long as you're looking at which assets and the fundamentals of each and where they're going, I think what we'd always look at in an acquisition would be, is it going to be in more demand in 10 years' time than it is today? And that's a pretty good rule to have a look at, and understanding growth and infrastructure and in those locations as well.
I think it's interesting you mentioned the different industries, because that's something else this budget hasn't considered, is the real estate agents, the buyer's agents, the conveyancers, even mortgage brokers. It's something that hasn't really been spoken about, those industries that, in my opinion, are going to have a significant downturn. Otherwise, they're going to have to pivot. As you said, certain buyer's agents are trying to start to play in the commercial space.
Even down to the little guy. I was following a van the other day and it said, we do property management maintenance. And I'm thinking, well, are you going to suffer in the future because there's not as many properties to maintain? Who knows? I agree. I don't think it's been well considered that how much impact it's going to have across the board. So I want to go back to, Gareth, what you just touched on, small business. So really, as a result of all these changes, how have they been impacted and where to?
Yeah, so we had a couple of major announcements at budget night, and then we were waiting to see where the dust settled on it. I'll get Bodie to run through in a moment what actually came in, because there was some changes. So what was initially announced and then what came through a bit of negotiation to get the bill passed, there was some changes. The big question that we had was really around strategy for what's the most appropriate structure, and that changed significantly. So there is this misconception that discretionary trusts, family trusts, were a vehicle for the wealthy, and that probably comes back to a lot of tax planning that can be done when you do have a discretionary trust. The government decided that they wanted to try and make that less desirable because they felt that was a vehicle for the wealthy. And so they've imposed some minimum taxes on distribution. So regardless of who the recipient is, the amount of tax that has to be paid anyway. And so maybe that was the most appropriate asset protection vehicle. And it was also potentially quite efficient from a tax perspective as well. Is that necessarily the right structure now? Possibly not. But there are other vehicles, such as just using a standard proprietary company, where the tax rate's the same now as a discretionary trust. Because there's this minimum tax of 30%, the investment company, so a passive company, has got the same tax rate. So there is no difference between the two. So it seems to me that they've arrived at this sort of minimum 30% threshold, because you see the theme across a lot of different things. So, if you've got over $3 million in your member balance, there's now a 296, Division 296, 15% to take your total tax up to 30%. We're seeing it in discretionary trusts. We're seeing it in companies. You're seeing it across the board, where there's this creep to try and get all of these things standardized, other than those lower marginal rates in your personal tax return. So The other thing we saw was capital gains tax. So there was some pushback on that because the definition for ever and a day was, that a $2 million turnover was a small business. And so the Greens said, I think we need to look at that, and arrived at 10
million. Yeah.
So where that's important is if you do start your own business and you build it up, there are these small business capital gains tax or CGT concessions, and they only applied if you fit within that definition. So now it's expanded to include more people, which is a good thing.
And it definitely reduces the capital gains tax should you have a startup with a cost base of essentially zero and then sell down the track. So it is an incentive for business. So there was some silver lining.
And it's interesting because they needed to do it because, we had, entrepreneurs, business owners who are asking the question when they're in things like tech and things that aren't necessarily needing to be domiciled here in Australia, why start a business here? We're getting penalised where if we go to other jurisdictions, there is no capital gains tax. So if I'm starting out a business, why would I do it here? I can still sell to the market here. And if I sell my business later, then I wouldn't be slogged with, capital gains tax. So these things were really important to try and keep entrepreneurship in Australia, which without that, you lose employers, and that is a real flow-on effect to the economy and productivity. I
always thought commercial property was always for the super wealthy.
Yeah, and I think that's probably a common theme. I guess it just happens that we all are on that traditional journey of this investment in a residential property is how you traditionally build wealth in this country, or one of the vehicles. And commercial has always been sort of in the background. Our team's got over 30 years of experience in commercial property, and so we've been doing it for a long time, and it hasn't been, it's just now that it's in the news because of these changes. The fundamentals and the reasons why people enter into commercial property haven't changed. And as we touched on before, it was generally speaking, it's when someone has got to a point where they're looking to add to their strategy or increase their cash flow. And, they've got enough equity and a few other assets that cash flow becomes important in their journey. So it's always been there. Not many of the fundamentals have changed. It's just flavour of the month, really.
Is it harder to access? Because I think about it and I'm like, we jump on Domain, we jump on realestate.com and we can see the properties, whereas where do we go shopping for commercial properties?
Sure, and the shopping for them isn't the shopping for them isn't the hard part. Yeah. There's the same type of platforms that you can go and look at, but it's the research and the DD that needs to be done. You can go on a bunch of websites to get suburb vacancy rates, growth things in residential. In commercial, it is a lot more difficult. The likes of in office space in the key markets around Australia, there is a Property Council of Australia who publish a report each half year with vacancy rates of each capital city and suburbs and what grades. But outside of that, there's very little commercial published data, no industrial, aside from there's reports that you can get of 5,000 square metre plus industrial. But in the weeds and the smaller assets, it is boots on the ground, and it is, typically we would spend, it's probably 5 hours plus in researching vacancy rates in areas and demand. So that would be talking to property managers, agents, doing all that groundwork. So it is much more intensive in that respect because there's not as much free information or information freely available to the average punter.
And, if we think comparatively between residential and commercial, we're like poles apart in terms of how many people hold themselves out to be experts in residential versus commercial. As you've just identified, there's a lot of proprietary data held within the people within the industry. We're concerned about how many people are going to put their hand up in the next few weeks and say, I'm now an expert in commercial, when they don't have that data. So they're flying as blind as the person looking to buy the asset. Is the takeaway from today, ask the person who says they're an expert before you engage them, how long have you been doing this? So that they've got that expertise, the experience.
Absolutely.
And secondly, that they might have access to the really rich data they need to make the decision on whether it's viable or not.
Correct. Yes, very much so. And having some experience in understanding what leases look like as well, because they are the key driver in the growth of your asset. So understanding what it takes to lease a property, all the intricacies within a lease.
So with that, Nick, a lot of our viewers, listeners are going to understand residential probably more than commercial. For their benefit, in residential, you typically see the same lease. It's a template generally from regulatory bodies or industry bodies. In commercial, they can come in any flavour you want, depending on which lawyer drafts them, right?
Yep.
So you've got to read them and understand them because they're not all the same.
Mm-hmm. They're generally longer. There's generally more obligations on both parties, so it's important to understand what those are. Things like the make good at the end of the lease, what are tenants required to do when they exit the property? It might be defit the whole premises, return it back to a shell, what that means, who's responsible for what, and then what potential costs are on either party because of those clauses. Some leases will have break clauses in them, which is another whole
demolition and development clauses.
Correct.
Yeah.
So there is an awful lot to look at in a lease, and not only the lease, understanding who the tenant is and doing the DD on. And you couldn't go to your residential tenant and ask for a profit and loss to understand if they can actually,
it'd be good if you could.
It would be good.
Yeah,
but
household budget. Yeah.
Generally speaking, you can have those conversations and get those things from a tenant if you're looking to acquire a property. So there's a lot of things to look at. The leases can be quite intricate, and having some leasing experience as well is probably quite crucial.
And I think as part of your team of advisors, that's really, again, not just standard sort of conveyancing law firm. It is a specialty legal space as well, where you want to have in your team, in your corner, a solicitor who's experienced and has that expertise to be able to give you proper legal advice as to what your instruments, what your documents are actually saying.
Yep.
What about the property management side? So is it the landlord that does the property management? Do you engage a property management or a leasing consultant? How does that work?
It depends. Depends on how sophisticated, I guess, a purchaser or a landlord is. Quite often, yes, having a nice arm's length management piece and someone to lease it. There's a lot to factor in and consider in commercial property. So having a managing agent would be a really good step. You can those costs of that engagement are included in the outgoings that a tenant will pay as well in most cases.
But let's talk about if you don't have a good property manager, and I've seen this, you would have seen this, where outgoing calculations are miscalculated, and as an investor, as an owner, you've done yourself an injustice by trying to do it yourself. But in reality, as you say, a lot of commercial, the tenant actually pays the property management fees. So it's worth engaging a proper experienced.
Yeah, and I think what we're going to see, and we already are, is those buyer's agents. And I don't like to refer to that part of our business as a buyer's agent. I think it's more an acquisitions or a advocacy strategy piece, because we have I'm not going to buy something on behalf of a client that we can't lease if it is vacant, or we don't want that headache either. So we're really working, as a holistic approach, looking at it and saying, okay, we can purchase. We think it's a good purchase. We can add the leasing expertise and look at the lease behind it. Also, it can be managed professionally as well. So looking at the whole thing is a very important step, and there's quite a few that won't have the ability to do that in the market. Being able to look after each of those steps understanding them is crucial.
It's sort of that transactional approach, isn't it? Where it's like I get a deal done, I get paid a commission, and I'm gone. And you see that in the residential space as well, where it's little care given to whether the data is accurate. I've sold you a property, I'm moving on. Whether it delivers,
Be careful, Gareth. You're going to open me up to going on a bit of a rant. But The one silver lining, to use your phrase, out of this whole budget, and we'll come back to Nick in a minute, but the one silver lining in the residential space is when events like this happen, it's a way of tidying up the industry. There are going to be a lot of, dare I say it, spruikers, a lot of marketeers that were feeding off everybody's momentum and wanting to act like sheep. When times get tough, those people disappear. So it's got a bit of a way of tidying up the industry because, there are people out there that were being sold properties that they didn't do their due diligence on. The numbers aren't great. The performance isn't great. So I'm glad that there'll be a shrinkage of those types of people in the industry. But yeah, it's definitely a good thing that's going to come out of it. One thing actually I want to share, Nick, I just want to share with everyone, this isn't his first day on the job. It's not his first day in the profession. Nick's been
grey hair.
Yeah. Nick's been heading up our commercial division of Sevenfold Property Group for quite some time. But what is it, Nick? You and your team have got over 30 years experience in commercial?
Major corporate commercial agencies as well, whereas in senior positions and handling everything from leasing to purchasing and selling on behalf of landlords. So we've been on the other side of things in that respect. So we understand how those transactions work and then to be, having a top-down approach and understanding all of those things, now we're really well placed to, acquire assets for clients, understanding the whole process and with their end goals in mind. So it's been a while.
Yeah. So Nick and the team have got a wealth of experience and, certainly are very open if anyone wants to reach out and have a conversation about their, commercial opportunities there. So even though he's made his buy-in debut on the podcast today, we are going to be in some upcoming episodes. We are going to do some commercial-focused content. So I look forward to you joining me in future episodes. Gareth, I want to throw to you investment bonds. Can you explain a little bit more and have they been impacted?
Yeah, so we've talked about discretionary trusts, the similar sort of tax treatment for a company and this Division 296 or higher member balances and super funds. Investment bonds is a vehicle in itself as well. It's and it hasn't been touched at all in this latest round of tax changes. So investment bonds have been around for a long time. Most people know of them from grandparents or parents starting them when they have children or grandchildren, and they're used for accumulating wealth for that child, for university, first car, a lump sum, maybe for a house deposit. They're very tax effective because it's not treated as your own personal taxable income. So they get taxed within the actual bond itself. There's some rules around contribution, so you can add more to it, so you can keep adding to the balance, which after 10 years, if you take the money out, which is typically long-term for things like, providing for children and grandchildren, it's treated as tax paid. And so there is no CGT on the end of it as long as you've held it for over 10 years. So I think it'll be a vehicle to look at for our clients when they come to us and they say, my goal is to leave the workforce in my 50s, 52, 53, 55, doesn't matter, but it's going to be before you can stop working and access your superannuation. So we're looking for wealth accumulation that is before you can access super. So this is a vehicle that's really good for that because when we take in franking credits and other tax treatments, the average tax rate in those vehicles is often as low as 22, 23%. Which is the next best favourable to superannuation at 15%. So great vehicle for accumulating wealth. It's a long-term vehicle. It's not for short-term wealth accumulation, but it is, for example, a good vehicle for using if you're looking for how do I create a capital base that's going to generate me some income that I can rely on before I can actually access my super to fund my retirement.
And so is this a conversation they should be having with their financial advisor or?
Absolutely. Yep. So you need to be a licensed financial advisor to talk about any financial product, but also its suitability. So again, it comes back to a financial advisor who's authorised to provide the advice will understand whether this is an appropriate vehicle for you. It's not go out and do it yourself, because there's a number of rules with this, and there's also quite a discussion now around asset allocation. So what investments do you buy through the investment bond? There's a lot of options now. There's a real range, whereas, go back 10 years ago, there wasn't the same sort of range of selection. So there's a lot where you can actually, you can be quite bespoke with the portfolio that you generate inside the investment bond now.
Mm. So when we get to August 10, what's the change that most people should be considering? It really comes back to making sure that your strategy is in place, you're getting the right advice. Is it change overnight, or, what would your recommendation be for most people?
Well, August 10 only relates to borrowing to buy residential property. So arguably, whether it's now, before, after August 10, is about having your own strategy. That's why our organisation exists, because we want to take into account all of your goals, where you're at in life, what you're trying to achieve, come up with a plan. So I don't think August 10 makes any difference to that whatsoever, because you still have your underlying goals. What do you want to achieve for your family? What do you want to achieve yourself? They shouldn't change. Yes, there'll be some strategy that might adjust based on goals, and that's for a detailed conversation with an advisor that's just about your circumstances. I can't sit here today and tell everyone that's listening and watching that you should all do the same thing. I'm not the barefoot investor. I don't generalize. So this is about having a customized plan, which is where you need to engage into those one-on-one conversations. You can't do it one-to-many, because it just won't suit everyone.
And what's the process and forum for these unknowns to be tidied up, i.e., something like what is classified as new property?
Yeah, second round of legislation. I don't know the dates on it yet, but there is another bill that will come out that is to circulate. What I really was happy about is that they've said that they will define new residential property within the legislation. There was talk about allowing government departments to actually prescribe what that is, and they've said, no, this needs to come before government for us to decide what it is, so it can be debated. And there, it also can't be varied without going back through government as well, through Parliament. So that was probably a good outcome to make sure that that's actually properly defined. We'll also, I don't know what else we're going to see with another round of bills for second round of legislation. So there could be new things to talk about as well.
The frustrating part about this is it seems like a progressive announcement, and uncertainty and the hesitation that's happening in the market. Talk residential property. It's stifled the market over the short term. Where the latest data came in for June, and properties gone backwards 0.4% over June, which has primarily been Sydney and Melbourne, both going backwards 1.2 and 1%. But right now, everyone's sitting on their hands, waiting for. What investors don't like is uncertainty.
Yeah, and look, there's a lot to be talked about with what happened here. I mean, 12 months after an election where we're told something is definitely not going to happen, it happens without proper debate, without proper conversation, consultation. We then see, as it goes through the proper process in government, in Parliament, that it then goes through debate. We have Senate hearings and inquiries or a hearing to actually unpack what they're wanting to do. Seems very rushed, and that's what people have been concerned about, is that it's poorly considered. And whilst the Labor Party might have considered it behind closed doors, it needs open debate. It needs everyone to contribute to it, to unpack things that they won't have thought about, the impact to other things, the flow-on and domino effect, which hasn't happened. And so that's why investors are sitting on their hands, because they're wanting to wait and see what happens. Arguably, this is the best time to take action if you're comfortable with your strategy, because you're not competing with everyone else. This is the time where you should not pick up a newspaper, don't listen to the news, because that won't give you the confidence to move forward. If you're really sound in why you're doing something, it'll still make sense. But I can see why people don't have the confidence, because the media is certainly not helping with that. But it also, I think people are waiting to see how the flow-on effect to other areas. So what does it look like for business confidence? Things like that are going to be critical as to, are they going to employ more people? Are they going to invest in expansion? All those things are going to affect the economy as well.
I think I can't help but feel all this is going on, and we've taken the focus off government spending, high government spending, inflation. We're not talking about those things as much at the moment because we've been distracted by budget and self-managed super funds.
Let's talk about a budget. It's simple. It doesn't matter whether you're a government or a household. It's about receipts, income, and it's about where you spend your money or expenses. Difference in a household is your savings capacity or, what you've got to invest. Government spending is a critical part of the budget. And this last round of 6 weeks of negotiations has meant that the NDIS program, which was supposed to deliver a significant reduction in expenditure, has been delayed. And so whilst there should have been a significant reduction in expenditure in NDIS, whether you believe in it or not, their numbers on what it will do for the government's budget have been significantly moved. So the outcome as to how they announced it on budget night, with all of these changes we've talked about today, have significantly changed what revenue, what the impact is to different sectors. But the NDIS spending that's still continuing until they deal with it later is significantly impacting on whether there'll be a surplus or not.
Just to add to that, I don't think the changes that they've made are actually going to relate to the amount of income that they're expecting to receive. I think, as we spoke about last time, people are going to halt selling. They're not going to sell residential properties. So that CGT increase or the indexation is actually not going to generate more income. No,
but I think what they really didn't consult well with is the state governments. So whilst there's a long-term consideration to those changes on the federal budget, significant short-term impact on state governments, because with the number of volumes of transactions that aren't going through, stamp duty is a large revenue source for the state governments.
Land tax, they're not allowing people to grow their portfolio for investment purposes, so land tax is going to be impacted.
But the big one is the transactional stuff, and I think as well that with confidence being knocked to levels that we haven't seen since GFC. Business confidence means they won't be employing people. That impacts on payroll tax. So the state government budgets are really the ones to watch, because I think there's going to be some real impact to them.
Which then has a knock-on effect to infrastructure and
long-term investment. Yeah.
So the RBA's forecasting that inflation's not going to be in range until 2028, which means unlikely that we're going to have a huge move, or not going to have much movement in interest rates. So it just layers on more pain for the mum and dad.
Government spending is what's prolonging inflation in this country. And whilst they keep pointing fingers at each other saying, it's government spending, no, it's not. It's your control over inflation over with the RBA. Everyday Australians are getting impacted. None of us are really all that interested in the finger pointing. It's about, let's get together and work out how we actually get more productive for all of our benefits. So, the projections around inflation are very difficult, whilst we're still really unclear as to what's happening in Iran as well. So how long that's prolonged, is the peace deal hold? Is there a peace deal long term? What does it look like? It's a real tough one to call as to what will happen.
And I think it comes back to what you said before. I guess I want to finish this on a positive because we are talking a lot of frustration, a lot of uncertainty. Let's face it, frustration is key at the moment because we're all frustrated with what this current government's doing. But I want to end positively. It comes back to what you said before. It's about the individual having the right strategy and getting the right advice to suit their circumstances to move forward. And I think that is more relevant now than it has ever been because we are in a very complex, confusing position in the environment at the moment. So,
yeah, whilst there is still some balls in the air that we're waiting to see how they land, we are more certain than we were last week. So
True.
We have at least some legislation. We've been, talking to clients, but saying we have to delay these conversations until we actually have some legislation to work with. So, a royal assent of this first round gives us certainty. It's one step closer at least, whilst we've still got other variables to think about. It's, starting to at least give us some certainty around those things.
I think it also gives people time to reassess. The strategy previously that would work doesn't anymore. So it's time to actually sit down, reassess their goals, what they want to achieve. And if they sit on their hands for the next 2 years until we get a new government, then there's opportunities that are going to be missed within that.
Yeah.
And even if it's not residential property, is it commercial? Is it bonds? Is it another type of financial investment? So I think it's giving people the opportunity to really reassess what matters to them and where they want to go.
Well, as Nick touched on before, in every cycle, there are ups, downs, changes, and opportunities. So it's another opportunity. Thank you for watching, and we will be back to our next podcast in the coming weeks, and possibly we'll see a bit more of Nick.